Hi there and welcome to the Stockscores Market Minutes for April 2nd, 2012. This week's topic, pullback or correction, how to tell the difference. Quick reminder, you can get my free weekly newsletter at stockscores.com/newsletters.asp. We're also putting on a series of active trader expos across Canada. You can see the dates and locations on screen. For information and to watch a quick video explaining what we're going to be doing, go to stockscores.com/expo. All right, let's get into the analysis. It's always good to understand the difference between a pullback or a correction. Now, a pullback is essentially a move against the trend without the trend being broken. So in an upward trend, we'll go up for a little while, and then typically we get a few days of weakness, and then we resume the upward trend. Of course, it's important to be able to tell the difference between that and a correction. Corrections don't happen very often, but when they do, they are often fairly harmful to your bottom line. Of course, we can all remember corrections in 2007, 2009, 2011. These are those big pullbacks that really bring down your performance. Now, as a generalization, pullbacks generally come back to an upward trend line, but not through it, while a correction will break the upward trend line and usually come from a falling top. What I mean by a falling top is where prices hit a high, pull back a little bit, rally again, fail to make a new high, and then pull back through that upward trend line. It's a little bit easier to see when we look at the chart of the S&P 500. You can see there I've got an arrow at the new high. So we don't have a falling top on the S&P 500. And that upward trend line that began in October, cutting across the pullbacks in November, December, well, that pullback, or pardon me, that trend line has not yet been broken despite the weakness over the last 4 days. Now, when you read the headlines, you're going to see a market that was down 100 points today, but that upward trend line remains intact, and therefore, as it stands right now, this is just a pullback. All right, so it's important to be able to tell the difference between the two. Keep in mind, most pullbacks do not lead to corrections. In a typical upward trend, let's say an upward trend that lasts 6 or 7 months, you'll probably get 3 or 4 pullbacks. Just in the chart that we looked at here in the S&P 500, that upward trend that began in October has had 1, 2, 3, 4. We're now in our 5th pullback without that trend line ever being broken. With that said, all corrections start with pullbacks. And that's something to keep in mind because we want to remember that there will be eventually a time when the market corrects. We need to be able to tell the difference. What you have to do is decide whether you're willing to ride out pullbacks in favor of the long-term upward trend. And if not, you should be selling the market when it runs away from the upward trend line. So going back to the chart of the S&P 500 here, we ran away from the upward trend line in late October, we pulled back. We ran away in early December, we pulled back. We ran away for much of the first part of this year, January, February, only had a little minor pullback here. So there you can see how the strategy of selling the runs away from the trend line often doesn't work all that well either. All right, well, we'll get into the analysis here. Looking at the S&P 500, you see a market that has had some weakness over the last few days, kind of a dead market over the last month where we were trending more or less sideways for a little while. But that upward trend line is still in place, so the buyers remain in control of the market. I like to look at the bond market. In this case, I'm looking at the 20-year bond ETF, symbol TLT, because when money is scared, it will go into the treasury market. We can see that the treasuries have come up over the last 3 or 4 days, but they are now at the downward trend line. And so we should find the bond market getting some resistance here and probably rolling over in the next few days. And I think that could coincide with a bounce back in the stock market in the same time frame. The VIX has also been coming up in recent days, but it hasn't broken its short-term downward trend line nor its long-term downward trend line, and so fear really isn't at a high point. Right now we're getting a little bit of a bounce back. I would say the market became too complacent in the last little while. I've talked about that in recent weeks, but the VIX isn't telling us that anyone's really running for the hills yet. The TSX is a little bit different story because it broke its upward trend line last week, something I talked about in the daily newsletter, and that tells me that the Canadian market is one probably best avoided. You'll find a few opportunities there, but generally speaking, Canadian stocks aren't looking all that good. One exception has been the financial sector. It's been doing pretty well. And really the problem comes down to the U.S. dollar. The U.S. dollar has been rallying. That, of course, hurts commodity prices. The Canadian economy is pretty focused on commodity prices, so that's an important issue. Now, the U.S. dollar is also running into some resistance at the red line on the chart. It fell back today. I think it could still have another day or two of strength before it really hits that downward trend line, the red line there. But what's important is that volatility in the U.S. dollar is compressing. If you look at the price swings from November to January and then the one down from January to March, the intensity of each price swing is diminishing, and that tells us that the world is getting a little bit more confident about how they are pricing the U.S. dollar. Now, my expectation is that the U.S. dollar will break through the red line if the economy in the U.S. is in fact getting better. Today there were some signs that maybe it isn't getting better. The jobs number that came out Friday wasn't that great, and that's really why you saw the U.S. dollar sell off today. At the same time, if we get down to the green line, we're going to break that green line if the U.S. Federal Reserve decides to do more quantitative easing. So if the economy is not doing well, then they're going to print more money, and that'll cause the U.S. dollar to go down, but that should also be supportive of stocks. Either way, I don't see a scenario, except a really crazy thing happening, where the U.S. stock market is going to suffer in the next little while, because if the economy is weak, the Fed will help out the economy with quantitative easing, and if the economy is not or is doing really well and doing strongly, then the U.S. dollar is going to break through that red line. But of course, that would come with an improvement in earnings in corporate America, and that should help the stock market as well. All right, gold market been kind of I would say a negative market over the past 5 or 6 weeks. Ever since Ben Bernanke kind of said that they weren't going to do anything in terms of quantitative easing, we've seen gold drift lower, but it hasn't broken that long-term upward trend line. It is definitely flirting with it. And of course, if we do in fact see enough weakness in the economy and more printing of money, then we'll see gold bounce off of that green line. But if the U.S. economy is getting better, I don't think people are going to be sticking in gold. They're going to be looking for a little bit better places to put their money, and we'll see that long-term upward trend line get broken. So I think it's pretty critical that you watch gold here. Brent crude, one of the oil markets. This is more of a global oil market than West Texas Intermediate. It has been sort of trending underneath resistance on this cup and handle pattern. It's really flirting with that upward trend line, so it needs to bounce back here and hold that. And again, a lot of this depends on what happens with the U.S. dollar and the U.S. economy, with politics in Iran, that sort of thing. I'm not a big believer that we're going to see a breakout in the U.S., in oil anytime soon, but something to watch for. If the global economy gets better, then you'll see a breakout through that red line, or if political tension escalates in Iran. So generally speaking then, bullish still on U.S. stocks, but we could see a few more days of weakness before it finds support. Canadian stocks, I'm pessimistic, but I think that's a relatively short-lived phenomenon. If the U.S. economy turns around, that should help the Canadian market, and if there's quantitative easing in the U.S., that would help the Canadian market as well, because of course that would boost commodity prices. So short-term pessimistic, but longer-term I'm not too worried about Canada. Gold currently neutral. I want to see that upward trend line hold and a good bounce off of it. And oil I'm neutral just because I think it's going to trend sideways under resistance. So recent weakness in U.S. stocks, really just a pullback so far. Canadian stocks are lagging, and so we want to sort of stay away from there in the short term anyway, because of that U.S. dollar strength, which is hurting commodities. Well, that has been the Stockscores Market Minutes. Once again, here's the schedule for the Stockscores Canadian Active Trader Expos across Canada. I'm going to be doing a series of educational presentations from 8:30 until noon in these cities. Free to attend, courtesy of Disnat. For more information and to register, go to stockscores.com/expo. Well, have a great week in the market, and as always, trade well.